I'm Keith McCullough. Happy Friday. I don't know if everyone's really happy this Friday, depending on what they're long. Hopefully they're not long of frauds. We're going to get behind the balance sheet here with a different kind of a conversation, but something that's quite pertinent not only to my career and my traverse or my journey, trying to find frauds, unearthing frauds. We found Sam Bankman fraud. You know, there's a lot of different kinds of frauds out there, but I wouldn't call it a lost art, but I'll get into how he, again, crafts his process. Steve, thank you for making the time. Steve Clapham.
Well, thank you for having me. I'm really excited to talk to you.
It's not everybody gets excited to talk about fraud. What I liked in your in me getting prepared, I get preparation notes, right? And one of the notes, correct me if I'm wrong, but you said, look, I applied to like 47 different firms in 2017 and I wasn't getting many bites, so I just started my own.
Well, it's a really strange thing. I mean, I think it's slightly different in the United States versus London.
Yeah.
But in London, age counts against you. It's really stupid, right? In investing, because the more experience you
counts
have.
Against us.
Yeah. I mean, well, the thing is, right, that if you are old, then you probably will miss some of these fancy Nikola type opportunities.
Right.
But usually in the end, you do well. But no, I was a partner at a hedge fund.
Yep.
We were trying to grow it. It wasn't very successful. And the founder came in and said to me, I'm going to give it till the end of the year. And but if we don't get either any more money or better performance, then I think we're going to close down. Mm-hmm. And I was thinking, we just moved to really flashy new offices in Mayfair. And I'm thinking, I'm on the hook for the rent. So I thought, well, maybe it would be a good idea to exit, because I don't think we're going to turn around the performance, and we're certainly not going to get any new assets when we're not doing well. And so I thought, why don't I apply for some jobs? So rather than go to Headhunter, because then word gets out,
yep.
I did it through LinkedIn. I applied for 47 jobs. So how many interviews did I get?
10?
0.
No.
Yeah. So,
Like what kind of jobs? Like analyst jobs?
Analyst jobs.
Oh, okay.
But I reckon, the average age of a hedge fund manager in London is probably 42. Mm-hmm. And they probably didn't want somebody who was 50-something mm-hmm. looking over their shoulder saying, oh, you sure about that?
Oh, you mean the guy who runs the place is
yeah.
the average 42?
Yeah.
Okay.
So I just thought, well, why not turn your experience to your advantage? I can't do anything else, right? My wife laughs, you can't put up a shelf. What else are you going to do? So I decided I would set up a training business.
Yeah.
And it's been really good fun. I kind of miss the battle in the stock market.
Yeah.
But, getting in at 7:15 in the morning, sitting at your desk and finding you've lost a shitload of money somewhere in Asia overnight and trying to work out why.
Yeah.
I don't miss that.
No, it's a bloody war. I mean, like when people talk about short selling or hedging, or I'm constantly trying to reframe it like in a positive way, right? Like if you could hedge, you would. It's a positive experience. Or the alternative is you're with Bernie Madoff or Sam Bankman fraud, or with one of the many frauds that have been out there on the U.S. stock side. But it's an absolute grind, man. Like we had this. I don't know if you call it a fraud or if I'm allowed to call it a fraud, but it's pretty damn close. This company MPW in the U.S. that we've been tracking for years, and the analyst, my partner at the time, Rob Simone, who was the analyst on it, he was our real estate or REITs analyst. I mean, it's just every day. It's like everyone's coming at you, and it's like, but the thing is actually going to go down 90 to 100%, the stock, and it did. But eventually, but it's just. Can you talk about that, like the difference, because you already highlighted it, the difference between coaching people how to figure this out, teaching them, which is a huge service. Thank you for doing that, because they don't teach it in business school, obviously, sure. Versus the actual in it every single day when you're at a hedge fund.
Yeah, it's quite funny. I've got a number of hedge fund clients, both here in New York and in London, and the big pushback I always get. I give them an example, and they say, "Yeah, but we shorted it then. The stock would have gone up 50% before it started to fall."
Right.
And that's the real problem with short selling, because there's always, and especially with a fraud, because of fraud, there's always somebody who's very believable, very credible, very persuasive, and they're very good at drawing people in. Otherwise, it wouldn't work.
There
right?
aren't many dumb frauds. These people aren't stupid.
No, they're usually pretty smart,
Yeah.
and they're usually pretty credible, and they're usually pretty likable, and you want to believe them. And that's the problem that, when I was at the hedge funds doing the forensic accounting shorts, I was very, very careful about that. Because you do not want to do these things in any size, because you can easily be way, way too early. And the trouble with a fraud is they come out with the results. Oh, they've beaten, surprise. So you always get caught with that short squeeze. So I think it's a very difficult thing to do. And really, you're much better off with a fraud. If you're convinced it's a fraud, you're much better off waiting until you see doubts starting to creep in the market. Because what generally happens is you get 2 or 3 waves where smart people spot that there's something funny. They go short. The short interest builds up, but the stock carries on improving because it carries on delivering great results. Nobody's worried about the cash flow because nobody's looking at it. And then you need some exogenous shock, some external event to really make the thing start to crack. And that's when you need to get in. And you can do that very effectively. I mean, something like Wirecard. I mean, it was probably 9 years that it went on. And you could have lost a lot of money over that time. And John Hempson, who gave Dan McCrum the original idea, Dan McCrum, who wrote the book, and was the FT journalist who had it. I mean, it was on the front page of the FT. Stock was still going up, right? That was particularly difficult.
Crazy.
But you could have seen it fall, and once it really started to fall, it's going to lose 100%, right? So being cute about the timing, I think, is really, really important.
Yeah.
With that.
I had to build an entire process around that, of course. I mean, I've been doing it for 25 years. Yeah, I was initially taught that the shorts were better than the longs because this game is generally when you arrive in the game. Like I started as a hedge fund analyst in the year 2000,
right.
So all things did for 2 years was go down.
Yeah.
So I had to have some level of competence, but the signal, which is what I always go back to, these days, 25 years in, is if the signal's not confirming, the market doesn't believe you, and unless you have a catalyst to confirm that tomorrow or next week that's explicit, then I'm not going to have it on. Yeah. But if it starts to break down, and we have multiple catalysts, including them having to report reality, which is a pretty big one that they have to generally do,
at some point,
every 3 months, then we can go with it. And it's been an interesting journey for me on that front. We've had to go head to head with Bill Ackman on Valiant. We've had to go head to head with Leon Cooperman on Lynn Energy. I mean, these are zeros, right?
Yeah,
and the whole time it was a constant fight. It's a constant fight where I'm the man in black from Hedgeye, and everybody else is the nice, I guess, God-fearing sheep. I mean, it fully loaded with the media. It's an amazing experience.
The Bill Ackman Valiant case was particularly curious because I can remember he'd floated the permanent capital vehicle in Amsterdam at the time, and I went to the AGM because I was very curious about what's going on here. And his team were all relatively young, the analyst team. But the pharmaceutical guy was the only guy with gray hair.
Yes.
And I'm thinking, am I missing something? And at the time, I was in contact with John Hempson, who obviously was very vocally short of it. And it's just bizarre how people will absolutely 100% believe the narrative when the numbers are telling them something completely different. And I do this forensic accounting course, and I have this slogan, and I put the course in 10 modules, and the third slide in every module is numbers over narrative. I got this screen full of numbers, and I say numbers over narrative. Because what people tend to do is they tend to be attracted to a stock because of a story. And you love a story, and then you read the numbers and you make the numbers fit the story. And I say, well, actually, if you start with the numbers, forget the story, what are the numbers telling you? And when the numbers are telling you something different from the story, you know that you've got a problem.
Yeah, it's an excellent one-liner. In fact, I use it all the time myself. And I don't think that it's something. I mean, you and I didn't have to get that from like the Hammurabi Code or anything like that. I mean, it's an empirical fact. I mean, but the fact is not clear. Like I always say this in macro. the rate of change of something decelerating or accelerating, an economy in particular, is an empirical fact looking backwards. It's not subject to debate. When you think about accounting, and what I found really interesting about just trying to learn about you on paper, which is completely different than in person, and thank you for being here in person, you're like, just read the 10K. But when somebody reads a 10K, like it'd be like me reading a legal document. I don't know what the hell I'm reading. I might think I know what I'm reading, but I don't really know what I'm reading. Reading a 10K, not everyone knows how to read a 10K. In fact, you think there's edge in reading a 10K, do you not?
Well, I mean, it's quite surprising. One of the big accounting firms did a survey, and it was a survey of about 500 analysts. And they asked them, do you read the 10K when you're analyzing a company?
Where was this survey, in the US or in the UK?
I think it was a global survey. It was one of the big four accounting firms.
Okay.
And they asked private equity analysts, they asked credit analysts, they asked equity analysts, and they asked rating agency analysts. So there were 24 rating agency analysts, and one of them admitted they did not read the 10K. You think, well, if you're a rating agency analyst, what else would you be doing? What else would you be doing? I'm like, but 2 in 3 buy-side analysts said they read the 10K. I think it was 73% of sell-side analysts said they read the 10K. But the thing is, what the other ones were doing, I don't know. But of course, when people are surveyed, they always exaggerate. They always make themselves look better than they are. So the real numbers are far lower than that. And I don't know how, I could guess how you could be a buy-side analyst and rely on the sell side. I don't think it would be a good strategy, but I could see how you're a buy-side analyst, a small firm, you're covering a lot of stocks, you rely on the sell side, and you're doing it just on the basis of the sell side research. You don't have time to read 110Ks or whatever the number is. I think your chances of outperforming doing that are quite low, but if you're a sell side analyst, I don't understand how you could possibly cover a stock without reading the 10K. I mean, it just seems impossible.
If you're
to me.
properly trained, like my first job as a junior, like just a fly on the wall junior analyst in the year 2000 for working for a gentleman by the name of John Dawson. The process was I'd get like called a stat pack, but really the pack would have the last 3 years of K's and Q's, and then it would have like some sell side reports, but it would be balanced, like the bearish one and the bullish one.
Yeah, bearish one would be small pile, right?
Yeah, very, very small pile, if anything in the pile. Yeah. But I would not be allowed to have an opinion without having done the base pack work. That was like a given.
Yeah.
So to me that sounds very odd, but in this day and age I think all you have to do is read a tweet.
Well, I think I think people have become very, very short-term focused. Right?
Yes.
Particularly here. And
here being the U.S.?
Yeah.
Oh my God, yeah.
When I was in the sell side many, many years ago, I used to get phoned up by Steve Cohen's firm. And they used to say, oh, Steve, we got the British Airways results next week. What are you going for? Do you think they're going to beat? And I always laughed. I said to them, I don't know why you're calling me, because I've told you before, I'm really, really good at forecasting company profits, right? And when I was a sell-side analyst, I had a very small number of stocks, and I knew them intimately.
Yeah.
So, I'd have done this 40, 50, 60, 70 quarters in a row. And I knew that my probability of being right was actually quite low. Because there's so many moving parts in airline. Yeah, you can predict what the fuel price is, but you don't know what their hedging is. You can predict what the yield's going to be, but you can be out by 0.1%, and that's 10% on the earnings.
Yeah.
So, would you put money on that? I said to them, I don't know why you're calling me, because this is a really stupid strategy, because you might be good at this, but I'm not.
This is why you didn't last at an investment bank.
Well, but
You're too honest.
The irony of this was that I was the Starmine #1 most accurate forecaster in the UK, not for my sector, but for the whole of the market. So I was good at doing it, but I didn't think it was possible. Particularly, obviously, an airline, you've got a huge sensitivity. But it amazes me how people are so focused on this now, and they spend, you could just spend the same amount of time and energy reading the 10K, and you have a big advantage.
Yeah. Well, part of that, I mean, in my stat pack, ironically enough, maybe not, the StarMine ratings would be part of the stat pack, because it would just, the buy side's just trying to save time. But you can't save time reading a 10K. You got to actually read it and know what you're looking for, right? Yeah. So then we had shortcuts, which is technology. Well, this is going to scrape or scan the 10K for keywords, and then you also had Howard Shillett. I'm sure you're familiar with him.
Yeah.
I mean, I wouldn't know if you compete with him or anything like that. But Howard Shillett would write this. He had this company called Cifra.
Yeah.
Right.
It's still around, right?
He's still around, right? But Cifra, that's different. That's a different pile. That the portfolio manager would get in his daily reports. Okay, well, Howard Shillett put this ticker on the list, and God help you if that was one of your long positions, on our team, because that would mean that you maybe didn't read the 10K.
Well, you might have read 10K, but you might not have just been fully equipped to analyze it. Right?
Yeah, exactly. Which is plenty of young analysts in the hedge fund business. They're analysts, but that's how you learn the job, right? By fucking it up, most of the time.
Yeah, I mean, I think there's not enough emphasis placed in things like the CFA on actually really granularly understanding what the numbers mean.
Right.
And particularly, I mean, I've got a couple of clients that recruit people with 2-3 years experience, and I take them through a course. And one of the things I do, I say to them, can you forecast this cash flow? Just do it roughly. I give them some very simple parameters. And it amazes me how few people understand that when you look at the cash flow statement, it tells you about the movement in cash, but it doesn't tell you about everything else that's gone on, right? So there can be a huge difference between what's actually happening to the net debt in the business and what's happening to the cash.
Yep.
And people aren't taught that. And even, this is a very well-respected firm. They're getting 200 people applying for for two spaces. So the guy or girl that gets the job is seriously good, come from a seriously high quality firm. I better not name any of the firms, but household name firms. And they just haven't got this.
Well, that's the thing. I mean, household name firms means if you stay there long enough on the sell side that you're not actually that good at the job. You're definitely not that good at the short selling job.
No, these are people that have been recruited from the buy side.
Oh, the buy side that brought them in. Okay, I got you.
So, and it really surprised me.
Well, it is. I mean, but it's based on the rigor of your ecosystem or your environment, right? I mean, like I would not be. They would put a bloody. They put it is back in 2000 when the internet had just started. So they put a projector up on the wall with our model, and they'd ask questions about it, like. What's the difference between CFFO and the stated EBITDA number? And we spent a lot of time on that. These telecom companies at the time were quite fraudulent. Yeah. And it was like, but you couldn't get, you would not survive 6 months at a high-end hedge fund, that was focused on accounting at its core. Today, I think people are screening for momentum factors, narratives, lead moment. To your point, it's not numbers, it's narratives that drive momentum. You have an entire community of people out there that are listening to this that are retail investors. I consider that an insult if you're called that. It's another thing to be a self-directed or aware or a competent analyst who's an individual investor.
Sure.
But the coagulation around these narrative-based stocks, I mean, it's like 99% of the names that people care on.
Well, I kind of have a certain amount of sympathy with the sort of innocent private investor who says, well, why should I bother with this rubbish? Because, doing the work isn't necessarily going to make you more money. And if you just follow the momentum and you just chase the stories, you might make more money. In the end, you'll end up losing it all.
Right.
But I've got a certain amount of sympathy when we've seen, the market do what it's done. That people say, well, why should I waste time? Why should I waste my time and energy doing it properly? Mm-hmm. Because I don't need to when the market's in this frame of mind.
In fact, you can we have plenty of evidence to suggest that because we know there are semi-frauds or at least companies that are let's just take Nikola. I mean, the guy rolled a car down the hill and called it an electric vehicle. I mean, there's just outright fraud. I mean, We can get into Tesla, by the way. There's plenty of narrative there.
I can't. I mean,
but
I've got a plane to catch.
But let's just let's peel it back first, because I really wanted to get this part of the conversation done, which is take us to what is your process? I know I already articulated in short form what the process was when I was first hired. But what is your process when you onboard somebody? And it may be different, of course, if it's a standing professional or an amateur who's trying to become professional.
So for the private investor that wants to learn,
yep,
we've got an online school.
Okay.
So it took me probably a year to build all the content. But what we do is we've got a course, it's got 500 lectures, and it's got, the first module is all about how do you read the accounts. And
lectures by you or by?
By me. So,
oh, wow. That's pretty good. In a year, it's taken me 17 bloody years to get to where I'm at.
Well, the thing is, I think it's really an unusual thing to learn through an online course. It's a relatively new phenomenon.
Right.
And investing, it's not really done. I mean, there aren't very many things that you can learn financial modeling or something like that, yep, but actually learning how to analyze. And so what we do is we take a European company and we go, and we've got the same thing for a US company, got a 10K, but we go through and we say, okay, how do you start? You open the accounts, you start at the back. And, well, why'd you start at the back? Well,
okay.
But this is like, oh, well, hang on. Well, the first thing is, if
where all the good stuff is.
No, but you laugh. But everybody, they open the front and they start reading the glossy, and they look at the pictures, and you don't want to do any of that. You don't want to look at any of the pictures. You do not want to look at the pictures of the management team. You certainly do not want to look at the pictures of the product. Or what you want to do is you want to start with the numbers. Right. And so you start in the accounts. And rather than starting at the front of the accounts, I start at the back of the accounts. Mm-hmm. Because under IFRS, the very last note is the contingencies note. And what that tells you is the company facing a whole bunch of losses? Mm-hmm. And this is a very simple, practical thing. If a company's got a contingency note that is 3 pages long and has got lots of big numbers in it, billions of dollars, you want to just leave it and move on, because you'll never be able to evaluate what the risk of that is. Right. So they're required to disclose this, and you just, if it's got lots of contingencies, lots of big numbers, forget it, move on to the next thing. And then say, go and read the audit report. Because the audit report, particularly under IFRS, less so in the US, but even in the US, the audit report will say one issue where there's been a debate with management. And that inevitably, and in Europe there might be pages of this stuff. Mm-hmm. And that's like the auditor shining a spotlight on, here's where the problems are. So if you start with that, you don't need to be highly skilled and have loads of experience. The auditor is saying, here's what you want to worry about. Mm-hmm. And then I go through the balance sheet. And so in the course, I go through, we've got a practical example, and I've got the accounts up on the screen, and I go through, and so we go through the balance sheet line by line. Mm-hmm. And I found that usually if there's a problem with a set of accounts, I go through the balance sheet, within 5, 10, 15 minutes, I found where the problem is. Mm-hmm. Because the problem is always on, if you're cheating, if you're manipulating earnings, there's only one thing you're trying to do. You're trying to boost your earnings per share. Mm-hmm. And if you're boosting your earnings per share, you'll always create a fictitious asset in the balance sheet. So all you need to do is look at the balance sheet and say, well, why have they got 180 days of receivables? There's a restaurant. No, but it's usually, and obviously I've done this. I mean, it's not because I'm smart, it's because I've done it thousands and thousands of times, and you just get programmed to do it. But those techniques are very simple and very transferable.
Well, that would be my definition of street smarts is amount of reps.
Yeah.
Amount of time at the switch. It's pattern recognition. Yeah. It's experience. No, you can't just, and that's why my question is just that you're trying to short circuit. It's impossible to get somebody who's been doing this for 3 to 5 years to where you're at. Not even close. I mean, you can get them to catch up to your process, which, again, most people don't even have a process. They don't start at the back. They don't then go to the audit report. They don't go to the balance sheet. That's like, most people are like, oh, I never thought about doing it that way. I bet you a lot of our hedge fund clients are sitting there saying, well, why don't I have my analysts doing it that way?
Well, I think that, there's so much focus on the P&L and on earnings per share. And there's one number that gets all this attention, and therefore you're distracted, aren't you? Mm-hmm. I mean, I don't like to look at. When I say I start with the balance sheet, I look at the P&L, and I'll have a very quick look at it. But really, what I'm looking for is what's the revenue this year and what's the revenue last year. I just want to know if there's been a big jump in revenue. There's probably been an acquisition or something. Mm-hmm. So then there'll be a big jump in the balance sheet. I might want to, have a quick look at the margins, but I'm trying to, put that to one side. I'm trying to understand: are there any red flags in the balance sheet? And if you see a red flag in the balance sheet, you then can work out from the P&L and the cash flow what they're doing.
Do you think that AI could automate, Steve, in terms of what you would be looking for, and do you could do 500 of these 10Ks in 5 minutes with a bot replicating your process?
I don't think so. I mean, it seems very surprising to me that we're 2 and a bit years into ChatGPT, and if you use ChatGPT to help you look at financial statements, you get all sorts of weird answers. Now, I've not even bothered to try, right? But I was listening to a podcast with a hedge fund manager who I think is very good, and he was explaining that he'd been looking at this stock, and he was chatting to ChatGPT. He was using it as an agent, and the company had seen quite a big increase in capital expenditure over the last 2-3 years. He said, "Why is that?" And ChatGPT came back and it said, "Oh, that's because of this acquisition." And it said they'd acquired a division from another company. It so happened he knew the other company. He knew it hadn't sold this division to the company he was looking at.
Oh, wow.
And he goes, "No, that's not right." So imagine, how dangerous it would be if you used it in anger like that. And it's interesting. I mean, I've been trying to use AI quite a lot just to learn about it.
Yeah.
So I did I've got a Substack goes out every Sunday, and a couple of weeks ago, I did an article on the top 400 finance Substacks, mm-hmm. and I used AI to categorize, all the Substacks and to work out what the monthly cost was in dollars.
Yep.
And so, and I went through and I checked the first 20 or 30 categories, and I went through and I checked that it calculated the currency conversion correctly, and I checked that it could divide by 12, and so I did that for 20 or 30 things, and I thought, well, it's done that okay, so it's probably the rest of it is okay. But in the text, I said, I have used AI to do this. I haven't checked it myself, because I think it's very dangerous to rely on this, and I can't imagine anybody doing it today in investing. Now, that's not to say that people haven't created their own agents and created their own intelligence. And I'm working with a guy in Germany who's he's got data on 9 million companies. Mm. So he's taken all the German Mittelstand companies. He's taken all the UK filings. There's various jurisdictions in the world, in Singapore and Australia, where private companies have to file accounts. So it's very unfamiliar in the United States. But in the UK, for my company, I have to file accounts, and they're publicly available. Mm. So that allows you to get very granular industry sector information. So you can work out what. So I dare say if I was sitting in a quant's hedge fund with all that sort of technical resource, that's what I would be spending my time doing, saying, well, how far out are these ratios from that industry norm? Mm-hmm. And you definitely do the first part of the work to highlight where there might be issues. Mm-hmm. But I think it's quite difficult to replicate a really skilled analyst, even just with something as basic as financial information.
I asked that question because I have somewhat of a similar answer when people ask me. Like, well, why can't I just replicate your signal in quads? And why can't the essence of the question, or the line of questioning, is how do I make this a shortcut?
Yeah.
How do I not have to do any work?
Yeah.
I mean, whereas the reality of my craft and yours is to do all the bloody work. You know, it's like it's to study it deliberately and to see those patterns and to do it over and over again. And I think that that's a huge competitive advantage in a world of AI, because if anything, it's giving them false shortcuts, is what you're saying.
Well, what's quite interesting, so I used to have a client when I was on the south side who was one of the most successful hedge funds in London, really large fund. And we were talking about British Airways. And I spoke to the analyst, and he said, oh yeah, I'm putting in the traffic numbers in my spreadsheet. And I said, well, I can send you the spreadsheet. I've got all the data.
Yeah.
And he said, no, he said, I want to do it myself.
Yep.
And the reason he wanted to do it himself is that deliberate practice of putting the numbers in the spreadsheet means that you can see the patterns. And it sounds really stupid that, well, you know, that you would sit and take, I mean, the traffic numbers, right? Yeah. But also, you know, things like taking the numbers from the 10K and putting them manually in the spreadsheet, looking at the numbers year after year, it's a much more granular, slow, deliberate process. But it means that you've really looked at the numbers line by line and understood where there are anything funny. And if you just take the download from Bloomberg, I can guarantee you that, you know, some of the data will be wrong because it's some girl in the Philippines putting in the data that doesn't have any idea what the numbers mean, right? So one year, one of the numbers will go in the wrong box. And it might just be the number that you really need, right? So I think it's very dangerous to rely on all that data.
Yeah, and it sounds like work. It sounds like a lot of work. You know,
well,
so that's where people don't, you know, and that's, I think we've established that in the first part. And then there's, of course, the industry pressure. I mean, you can take Adam Jonas's, I have to come back to Tesla, but I mean, you can take Jonas's model on Tesla, and you can just look at the validity of the model and the assumptions embedded therein, and you're like, this is like an investment banking joke, right? You would never come to those conclusions if you were deliberately studying the company's filings, statements, actual reported numbers. You know, so can you talk about there are a lot of industry dynamics that have set this up as a trade that is almost like, again, you and I are from the past, you know, we're from like, we're
history,
the dark, we're the dark, like I'm 50 now, so I've been knocked out of your range there. I'm not 42.
You're unemployable.
I'm unemployable, I know that. So I have to stay here, so thank you for being with me. But you know, can you talk about some of the, you know, there's MiFID, there's a lot of structural issues, there's just why structurally, certainly sell-side research and modeling is never going to do anything remotely close to what we've discussed for the first 30 minutes.
Well, I think the MiFID 2, I think, is quite frightening, the implications of it. And
U.S. investors might not know what that means.
Yeah, oh, sorry. So MiFID 2, it was a rule brought out in Europe, which effectively meant that you couldn't pay for the research that you got from the banks through the fund.
Through trading, yeah.
So most, not every fund, but most, particularly retail institutional investors, took that bill on their own P&L rather than funding it through the trading costs and through the fund. And what that meant was that the commission pool shrank very, very dramatically. And of course, what happened initially was everybody was saying, well, we've got to cut costs because we're actually having to pay for it ourselves. And they really, really undershot. Mm-hmm. And so I think this came in 2018. And I mean, there's some hope because actually the amount of money committed to research in the last couple of years in Europe has actually gone up. Mm-hmm. Small, but it stopped falling. But the consequence is, if you're, a friend of mine was the head of research at Bulge Bracket Bank, and he was miserable. And he said, you know, I get one of my really good analysts comes in, he says, you know, I'm going to a competitor, I'm going to a hedge fund. And he thinks, oh man, I've lost that really good talent. Mm-hmm. And you know, it's going to be that much harder in the II survey next year. And then he looks at the number two and he thinks, oh, number two, she's 200,000 cheaper. So I've saved. And the problem they've got is they're managing to a falling revenue line.
Yeah.
So they've got no choice but to cut the costs. And how do you do that? They've already cut the training. They can only do that by cutting the numbers or the experience level. And so, you can kind of understand how we got to this situation. And it would be my contention that the sell side isn't what it was 10 or 15 years ago. Nowhere
Not
near.
even close. I mean, it's been completely neutered. I mean, I would say that it's incumbent upon everyone that's watching this, like the actual investor, to hold their manager to that account, right? I mean, the one they're really screwing is, well, they're screwing themselves because their future returns are going to decline, or they'll just be a benchmark hugger or whatever. And they're just hanging on to that melting ice cube of compensation while their return to the investor, who hasn't gotten a cut in fees, generally speaking, sometimes, is just getting a shittier product. A product that's not vetted, a product with no experienced analysts analyzing it at a bare minimum.
Well, I mean, the asset management industry's got quite a few problems, right? So the growth of passive, the increasing concentration within the index, particularly in the United States. I don't think the asset management industry. I don't think it's populated by entirely bad people.
No.
But they're struggling with a really difficult market environment, not just the stock market environment, but the market for their products. But the solution is to invest. Well, my criticism would be that faced with this dynamic, how are you going to deliver good returns for your clients? You're only going to deliver good returns for your clients by doing the work.
Right.
But the opportunity set, I think, is much, much greater today than it ever has been.
100%.
So, if you have really good analysts and you do a really good job, you can make a lot more money for your clients. But trying to do the shortcut, not going to work.
Well, when the shortcut's based on a compensation scheme, it's worse of a shortcut. I mean, the demand to just want to do less because people are lazy or don't have the competence, even if they weren't lazy, that's different than saying, okay, look, because there's a lot of ways you can get hard work. You can pay for it. I could tell you post MiFID, my revenues in London dropped by at least a third.
Yeah, I mean, you're lucky.
It's an independent research company. I don't have a broker dealer, I don't have a bank. All I have is what's coming out of my hands and my mouth. And my team just gets completely cut because now they're like, okay, well, we'd rather that money goes to us in terms of compensation than to you, because I have to compensate you out of my bonus pool.
Yeah.
That's the trade, right? So and that's a choice, right? That's a choice.
And I mean, I don't think the regulators were doing something that was necessarily a bad thing, because what they were saying was that, well, hang on a second, it's the clients that are paying
Exactly.
and shouldn't it be the manager paying for your work? And inevitably, when you go through that sort of transition, inevitably the quality of the research has to go down.
Well,
right?
because if the manager has to pay for it out of their own pocket, they're not going to pay for it.
Yeah.
And therefore, you get shittier research, and you're caught offside more often. And I think it does perpetuate nobody could see Valiant coming. Nobody on CNBC could see it coming. They'd have Bill Ackman on, pumping his book all the time.
He's very good at that.
Oh, it's a business. It's his business model. I mean, it's their business model. It's to get these people to do these types of things and to fleece those who wouldn't know otherwise. I mean, I think that is, front center danger that's not going away until those things go away. I mean, and those things aren't going away.
Well, I mean, to be fair, I mean, there's been far lower incidence of fraud, with the exception of Valiant and a couple of others in the United States. I mean, we've had a much worse situation outside the United States.
Right.
So if you're a global investor, you've been much more at risk. And oddly, for reasons that I can't really pinpoint, because you would imagine that UK, we were quite good at detecting fraud, and we should be. Well, when you think about the UK, we think of ourselves as being, we've got a great legal system, we've got, good regulators, good regulation. But we've seen, I can't tell you how many frauds in the UK. It's been a disaster.
Do you think it's because, I mean, well, there are more analysts in the US, there are more funds in the US, they're covering like...
No, at Sarbanes-Oxley, I think it's made a big difference. And it's extended the amount of time for the audit. The directors have to sign off. So it's a much more dangerous thing for you as a director in the US to start manipulating. Having said that, manipulation is at an all-time high. I mean, I am amazed at household name companies. You know, companies that my clients think of as high quality. And I'm saying, well, no, they're not. Because you look at the accounting, it is ridiculous.
Am I the first person to have 40 minutes with you without asking you for names yet? I mean, I'm like, most people, they just want the shortcut. Like, tell me what the fraud is. Tell me what the next fraud is. I mean, the one that you revealed recently, what was it, Greensill?
Oh yeah, the Greensill was an interesting situation because I'd been laughing at this because I was saying, well, you know, it's perfectly obvious that this is fraudulent.
It's perfect.
No, I mean, it was honestly, it was so obvious. And Mark Rubenstein, who writes the Net Interest Substack, he was just starting, and he said, "Oh, Steve, can we do something together?" Because I had an email list before I had the Substack, and you know, I had a few thousand people in my email list. And he said, "Could we do a joint piece? Because then, you know, I can get access to your email." So yeah, of course. And he's a brilliant writer, and he's really, really good. And so we did this piece, and he did a great job on the whole background to Greensill. And I just did a little thing where I just took the company's house filing, so private company filing, and there were like 10 red flags. I mean, it was you know, just not, I mean, it wasn't even, you didn't even need to look at the numbers with any detail. I mean, it was just blindingly obvious. And we wrote this, we published this together, and my normal modus operandi with something like that used to be, I would plant it in the Sunday Times, which is the business section of Sunday Times is really well read. So it's got bigger circulation than the Financial Times in the UK. And then on the Monday morning, I would go on Radio 4, the Today program, which used to have 7 million listeners. But you think there's 60 million people in the UK. So it's not really, it's the biggest show in radio. And they have a market report at 6:15. And of course, on the Monday morning, they're always short of news because nothing's happened, right? And neither the editor, the business editor of the Sunday Times, nor the markets editor of the Today program thought Greensill was interesting. Of course, when it blew up, they were kicking themselves. And of course, it blew up in spectacular fashion because David Cameron, the former Prime Minister, was being paid $1 million a year to be an advisor. So it was a political thing.
They often are. That's their protection when it's that obvious. I mean, look at, I say Sam Bankman-Fried, I mean, Sam Bankman-Fried from FTX. I mean, he was paying off all the politicians. Yeah.
I've got a great slide in my forensic accounting course with him interviewing Clinton and Sir Tony Blair, and saying, you know, its association with respected individuals confers respectability. And that's why Lex Greensill had Cameron, because it gave him respectability. And what slightly puzzled me was why Masayoshi Son got involved. Because, you know, we looked at this and we thought, well, there's no technology here, right? It's a very simple lending operation, right? There's no, I mean, there's nothing for Masayoshi Son. And then we understood, because Greensill was lending money to the ventures that Son was backing. So, you know, so hang on, you've given them money, and then they're lending money to your VC, your VC-backed startups. So it gives the appearance, it makes the startups appear that they're able to continue without having further equity.
Right.
There's no bank's going to lend to them.
No, of course not. Are there any, when you say, I mean, that's quite a statement. You've been doing this forever. I mean, you've never seen more? Like, I mean, so what would something big be here in the U.S. that you see very clearly that American investors are just like, I call them uniquely American sheep sometimes, but I mean.
But I mean, every company in the S&P 500s up to some accounting trickery or, I mean, no, they're all, but you laugh, but they are all exaggerating their earnings. All of them.
All of them.
Well, Berkshire Hathaway.
Okay.
I'm sure it's fine.
Yeah.
I don't.
But what would be some of the more egregious ones? We already talked about one, but you said you don't want to be here all day.
So, I mean, the one that I used to get a lot of pushback about was Nike.
Really?
And people said, oh no, Nike's a really good quality business. And in my forensic accounting course, I've got between 150 and 200 examples of companies that are cheating. And because how do you know how to spot it? You've got to see, right? And rather than do a fictitious, this is what it will look like, I think it's much better to say, well, here's the accounts and here's what it looks like.
Yeah.
And so Nike makes multiple appearances in this course.
Wow.
And the clients would say to me, no, but Nike's a really good company. I said, no, Nike, I'm not wearing the Nike sneakers, but yeah, Nike, the products are nice, but I'll tell you what, the numbers are not the same quality as the shoes.
You know what the craziest thing, one of the craziest things, there are many, many, many crazy things that wouldn't apply to any other part of natural life and many other professions. But on Wall Street or on, like in the UK or otherwise, they're tolerated because that's how people make money. I mean, just these general comments that it's a great company or it's a high quality company or that, like Elon's brilliant. Oh, I hear you that they just made up that number and this number, or said they're going to have the burrowing company do this and it didn't do that. But he's brilliant. Like, I mean, next to professional athletes, we're talking about the most highly compensated professionals on the earth that are getting paid to give you this pablum, these generalizations that completely refute like what the tradesman has concluded by actually doing the work that they're paid to do.
Yeah, I found it very puzzling. So Nike I found particularly odd because I'm not saying it's a fraud or anything like that. What I was just saying is that they were managing their earnings in a very aggressive way. So, if I'd been the CFO, the earnings that were reported would have been considerably lower. And you then have to ask yourself, well, what are you going to pay for those earnings? And so my whole thing is not about, I'm not out there saying to people, oh, there's loads of frauds, you need to worry. What I'm saying is actually something quite different and almost more dangerous. What I'm saying is there's lots of high quality companies that aren't as high quality as you think. And so it's fine as long as their business carries on doing well. But what happened with Nike was it hit a small air pocket. It was doing great in the DTC, but it kind of didn't do as well as it had been doing with its distributors. And then what happened to the stock price? The stock price completely cratered. Mm-hmm. And, would that stock price have cratered, fallen as much if they hadn't been managing their earnings and hadn't been as aggressive on the way up? Mm-hmm. Well, I suspect not. And I think there's lots of instances like Nike, and I don't mean to single out Nike, I mean, it's a good company, but there's lots of companies like Nike where they've boosted their valuation, and when there's a problem, the loss is much greater than it otherwise would be, and that's the risk for you as an investor. What do we care about then? We care about the stock price,
right?
And if the stock price has been inflated beyond where it should be, and then corrects, you're in trouble. And so that's the thing. And what's surprising, I think, to many people is that my customer base, you would imagine, would be all accounting-based hedge funds. Well, I've got a lot of accounting-based hedge funds, but I've got a lot of boutique quality investors, that quality growth kind of concept. And I remember one particular boutique in London, the founder was quite interested. He said, I think you should come in and train the team. Why don't you go and have a word with our head of research? And I went in to see the head of research, and head of research said, we only invest in quality companies. I don't think we've got a problem. So I said, well...
That's what I mean, these statements. Like, what the hell does that mean?
So I said, can you show me your portfolio. So I did an NDA and they sent me their universe.
Yeah.
And I told them how many of those stocks were in the course. And they're like, oh, well, but we better do this. And of course, and the whole team came, including the boss, to sit in the course. And when the first stock, when you could hear the silence, when the first of their so-called quality stocks appeared in the screen, and so oh, I think this one was on your list, wasn't it? And there was much, and that's the issue. It's not that there's a whole bunch of frauds are going to go to zero tomorrow lurking in your portfolio. There's probably some, but there's probably quite a lot of stocks that you think are fine, safe, high quality that might cause you a problem if they have hit an air pocket.
Well, I think that's so well put, first of all, but I mean, it's the willful blindness of the investor. I mean, is as culpable, like that investor saying, I am just long quality, and rarely has to face the mirror or the accountability of an exercise like they did with you. If at all, by the way. Many firms, as you well know, wouldn't take a meeting with you or me. But isn't it amazing, one of the most highly paid professions can be willfully blind and then almost exasperated by just doing one iota of real accounting work and then say, well, you're right.
Well, I think, so
their whole brand's been built on investing in quality companies.
I went to this quality conference yesterday.
Quality conference?
And there's very, very nice lady presented on a stock, and she said, we do incredibly detailed research. So this was a company in the vet supplies industry, and her analyst had been to 6 vet conferences all over the world and evaluated, spoken to the vets and how much you like this product. And there wasn't a single comment about what the finances were or what the valuation was. Now, I've got no idea whether this company's exaggerating its earnings or not. But if you're going to go to all that work on, we speak to loads of customers, do loads of surveys, shouldn't you do just as much work on, well, how high quality is the earnings number? That seems to me a sort of fundamental thing, right? You're going to do all this work over here. You don't need to do as much work. It's a lot easier to do. You don't need to go to 6 vet conferences around the world. You just sit there at your desk and read the 10K. People don't do that.
It's absurd unless you just get right down to the wood on why. And the why is because the compensation scheme is I get a premium multiple on a premium narrative.
Yeah.
Like you said, don't start with the glossy pictures or the product. But that's what they start with because they know that that's where they get the multiple. Where they get, how many firms are known for risk management or risk managing those numbers instead of the narrative? Very few. I mean, it's a thing. And I think that this is where people, let's say that you have somebody who's not in our profession listening to this, which I find this like a great blessing to have the people listening in. Because they're like sitting there and they're like, I know that I'm getting screwed somehow by somebody, but I never quite get all the details. And what you're talking about is patterns of behavior, right? It's one thing. It's not in my life. I have 4 kids, and if my kids were observing. I mean, I've studied kinesics and plenty of other things to give my kids cues on, like, well, what is the body language of somebody lying to? What does that look like? What is their expression? Like, that's how they live. And if I said, is that person seem like an honest and transparent or person of integrity to you? They'd immediately be able to tell you yes or no. This pattern of behavior, is not like there's lying, cheating, stealing. There's versions of all 3 that don't have to be fraud.
No, sure.
Right? But it's a pattern of behavior that you would not, that most people who aren't on Wall Street would say, I don't trust you.
Yeah. But I mean, I should just say that, if you're a CFO, you're kind of getting dragged down that slippery slope, because if you don't do it and all your competitors are doing it.
Or somebody else is going to do it. I mean, look at how many CFOs has Tesla had.
Can't even count. Too many to count.
You can't count. I mean, it's hard to keep track, right? It's a crazy thing. We've run out of time here. I could talk. We could go on and on and on. If there's like a parting thought, like to the people, you know what I mean? Like you spend an entire career on the inside of this, it can wear on us, right? But if there's one thing that you would tell to like the people that aren't like completely inside of this, like what would you say? Like what would you pay attention to or start paying attention to?
I at this conference yesterday, there was this young guy, an analyst, and he knew me, and he said, "Oh, you know, I should do your course because it's going to add value to my ability to do my job." Mm-hmm. And I said, "Yeah."
Thank you.
Especially, I don't know if there are any young analysts listening to this, but I'm sure there's lots of private investors listening to this. But, the thing is, do read the 10K. Mm-hmm. And, if you don't know how to analyze the 10K, ask yourself, well, what are you doing managing your portfolio, right? Mm-hmm. If it is not difficult. This stuff, to do it at a very detailed level is a bit difficult, mm-hmm. but it's not. Do the basic work and read the 10K, read the notes, and if you don't feel comfortable, there's a lot of stocks in the stock market. Yeah. So if something doesn't look right, doesn't smell right, or feels uncomfortable, just move on.
Mm-hmm. Well, I think having and I'll thank you for that on behalf of like everybody that is surely thanking you right now. To have the courage to develop something like that, like a learning platform, real practitioner content. Yeah. That takes courage because you have to leave, what I affectionately call the old wall. You might call it something different. If you can give me the one-liner in London, have at it. But it tends to rub some people the wrong way for the right reasons, right? For you to establish something that would never exist on the old wall, inside their banking and brokerage systems, that's great. We didn't need ChatGPT for that. We needed somebody with the experience and courage to do it. So thanks for doing that.
Well, thanks for having me. It's been good talking to you.
Yeah, we should find more people like this. But again, it's just as hard as finding frauds. So thank you for joining us. Please give us any kind of questions or compliments or otherwise. You can obviously look up Steve and his online school. You need to go to Steve's school. Thanks for joining us.